There is a big difference between making a good living and enjoying a good life. Making a good living has to do with earning capacity, whether it is in a profession or business. Enjoying a good life, on the other hand, depends on how the money is spent. Making conscious and deliberate choices about what to do with your money is the basis for a financially independent life in retirement. But for many, navigating the path of wise investing can be a difficult and intimidating task. Questions like, what is financial independence? How do I prepare for it? What are the principles of successful investing? How much will I need later in life? Are just a few of the questions that a professional investment advisor can answer.
I think of financial independence as living a lifestyle of your choice, feeling confident that you will not outlive your financial resources.
Joanne Gallerstein is the founder and managing member of JG Advisors LLC, a registered investment advisor with the Securities and Exchange Commission. Joanne's years of experience in the financial services industry have provided her with a wealth of knowledge and a commitment to providing fundamentally sound investing principles and strategic vision.
Of course, preparing for this is a process that has to begin long before retirement and requires an investment plan with a high expectation of success. But that's the easy part. The hard part is committing yourself to stay with your plan to fruition. I think there are really only 4 things that folks need to understand in order to be successful investors. The first is asset allocation, and then risk and expected return, diversification, and passive investing. So what do we mean by this? Asset allocation is simply how we divide our money into different categories, the 3 main categories being cash, bonds, and stocks. It is the single most important decision we make because each category has different risks and consequently different returns. And these differences in returns become very exaggerated over time. Risk and expected return are 2 things that go hand in hand. If we're looking for higher returns, we have to know that we have to assume higher risk. Safer investments like bonds generate low returns, but they do add a stream of income and they do go a long way in providing principal protection. Stocks offer us the road to higher returns, but we know the road will be a bumpy one. Simply put, the way we tilt our portfolio in favor of stocks or bonds will determine whether or not our returns are going to be high or low. Diversification means owning a variety of investments that are as different from one another as possible. It's the best tool we have to reduce risk. The first step is to invest in both stocks and bonds and then further diversify within each category. A simple example to explain the benefits of diversification is to think of what happens to airplane stocks and oil stocks as the price of oil goes up. As fuel costs rise, airplane stocks will go down and oil stocks will go up. If we were to own just one of these, we'd have sharp peaks and valleys, but owning the both of them smooths out our returns over time. Passive investing is probably best described by what it's not. It's not about looking for the next hottest stock, and it's not about trying to predict the next market move, both of which are essentially impossible to do well with any kind of consistency. Instead of the futility of looking for a needle in a haystack, we buy multiple haystacks. A simple type of haystack is an index fund, which groups multiple companies that share well-defined characteristics such as large and small companies, growth and value companies, and domestic or international holdings. The added benefits of using index funds is that they're low cost, they're tax efficient, and it's very easy to assemble a portfolio using index funds. And that's it. Those are the 4 most important things you need to understand for successful investing. One of the most common questions I'm asked is, how do I know when I can afford to retire? There is a rule of thumb to figure this out. Multiply your anticipated annual expenses before taxes by 25. This will give you a gauge what the value of your portfolio should be when you retire. So for example, if you anticipate withdrawing $100,000 each year, the value of your portfolio should be $2.5 million when you retire. This journey to financial independence is something we all can handle with the guidance of these 4 principles: an honest assessment of our goals and a commitment to stick with our plan. It is something we all can do, and there's no doubt in my mind that the effort involved is well worth the reward of independence.
Financial independence in later life does not come from how much is earned, but from good money management. It is never too early or too late to put into place a saving and wealth creation plan. Live the lifestyle you want to without depending on children or family. Let JG Advisors help you achieve your financial goals to provide you with peace of mind and security for the future. To learn more, contact JG Advisors today or visit jgadvisorsllc.com.